Hi, I'm Russ Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm lucky enough to be joined by Ryan Grabinski. He is a managing director and investment strategist with the firm, and we're going to talk all things markets. But first, Ryan, how are you doing today?
I'm doing well. So we've had 4 days of rain here in New York, so hopefully we get 4 days of sun coming next.
Yeah, something hopefully better on the horizon, and I think that kind of fits with the conversation we're going to have today as we start to think about turning the page on Q3 and this rough seasonal patch and look to Q4. But first, I don't think we can really start anywhere but the move in interest rates that we've seen over the last couple of weeks and months. And I know you all made a recent change to your asset allocation framework pretty much as a result of that move. So could you talk through that a little bit for me?
Absolutely. So obviously, rates have backed up. They're sitting about 450 as we sit here today. I will say that this has caused us to reduce our cash allocation ever so slightly and actually extend duration in our fixed income portfolio. I think from an equity standpoint, one of the things we've actually taken a look at is we've looked at when the 6-month rate of change in the 10-year Treasury is actually 100 basis points. And surprisingly, it's actually been pretty optimistic overall on average. If you look out 12 months, returns are pretty strong for equity markets. So at the same time that we think it's the right time to extend duration on our asset allocation portfolios, we also know that equities tend to have at least historically performed quite well through significant interest rate increases.
Well, let's talk about that a little bit then, because I do feel that sentiment has gotten pretty negative here. I mean, the backup in rates is a big part of that, but whether it's the worries about the country's fiscal situation with the government shutdown looming, or whether it's the resumption of student loan payments pressuring the consumer, it does feel like there's a bit of a kind of an economic growth scare that's reemerging after a strong summer. How are you all thinking about that right now?
Certainly, all the issues that you bring up with this, whether it's student loan repayments or the government deficits, these are all issues that are pretty well known at this point. That doesn't mean that they're not going to be problematic in the future, but it's known by the markets. So from my perspective, it's probably likely already priced in. It's usually the unknowns that tend to be more detrimental to the market. And obviously, if I knew what those were, I would be able to inform you, but I obviously don't. I think during the third quarter, obviously growth has been strong. Real GDP, depending on what model you're looking at, is anywhere from 3 to 4%. That's elevated compared to history. If you go look from 2010 to 2019. GDP growth was about 2%. So it's not really all that surprising that for the next quarter or two that we're likely going to see slower growth. If you look at what some of the companies are already telling us, they've already mentioned that demand is starting to fall off. This may be a result of those resumption of the student loan payments, but it's not likely to be all the end-all be-all or that derailing. One of the things that I'm focused on really is the employment picture. If you look at initial claims, they're still around 200,000. That's pretty low by historical standards. So as long as the employment market and the job market remain strong, it's really hard to see things really falling out of bed. Now, obviously, I do keep in mind that the interest rate backup is something that everyone has been focused on, and we are at those levels that created problems in the financial system back in March. So whether or not another problem surfaces in the financial market might be that unknown event that ultimately occurs. Obviously, that's not our base case, but it is something to be mindful of.
Yeah, absolutely. No one saw that coming in March, and then over a weekend, it was one of the biggest bank failures in U.S. history. So, time to stay vigilant with rates at these levels for sure. But with that in mind, that kind of looking forward, we are about to turn the page on a new quarter. Fourth quarter has been pretty strong historically, but what would be something that's surprising to you if it were to occur in the fourth quarter?
I think a really, one of the most surprising things would be if the equity markets were up 10%. It feels as though over the last several weeks, equities have sold off. They're down about 6.5% from the highs in July. And, sentiment has really shifted here. It seems as though everyone has gotten extremely negative on account of many of the issues that we cited earlier. But I think I would be surprised. Corporate profits could hang in, and if we get another strong reporting season on the earnings front, it certainly could be that catalyst to drive equity prices higher. And I think ultimately a rally in the fourth quarter would be a surprise that most investors really aren't talking about right now.
Yeah, absolutely. It's a good seasonal backdrop. Q4 is typically pretty strong, but as you mentioned, there's so much negativity that it does feel like it would take a lot of folks by surprise. So, look, we'll keep our fingers crossed because that sounds like a good outcome for me. Ryan, I want to thank you again so much for the time, and hopefully we'll get to talk again soon.
Absolutely.